Hello guys, today I got a new video on Motorcar Parts of America Inc. Ticker symbol MPA came up on my screener. Thought it looked interesting. It just has a $124 million market cap, so it is a smaller cap company. It hit at a peak of $25 and now it's down to $6 a share. I want to add to that this company could have bankruptcy risk from the financials I'm looking at, so invest at your own risk. This is not financial advice, and don't sue me if it drops like a rock. Okay guys, let's get right into the video. Alrighty. Well, now, of course, I had to pull up the Excel. Come on now. Okay, so let's just go over the basics and we'll get more deeper into the video. But I didn't really see any problems with, obviously, the financials. They look fine to me. It was only the only risk is interest rate risk, because this stock, which we'll get into later in the video, has a lot of interest rate risk. Inside ownership was only 4%, so they didn't really have a lot of skin in the game. Obviously, I like to buy stocks where the insiders have a lot of skin in the game, like 10%. You know, most of the time I just want 5%, but not a lot. And I think the stock is pretty. I think institutions own a lot of this stock too, so it is pretty illiquid. But this company only has 14 million in cash, so they don't really have a lot of cash, but they do have a credit line that they could pull out of. They only have 1.8 million in short-term investments. And then I just did obviously a blanket discount rate on accounts receivables and inventory to come up with the liquidation value. But if you do all that, your liquidation value or the liquidation value of the current assets is about $428 million. If you don't do any, discounts, you get 560 million. Then you come down here, and this is the discount rate for liquidation value in the stock. And you can basically get a quick liquidation value of $152 million. Obviously, guys, you want to get rid of goodwill and tangible assets. The goodwill usually is worth nothing, or always is worth nothing. Intangible assets, most of the time, is worth nothing, but you just want to look what it is, obviously, because if it says customer relationships, then it's probably not really worth anything. But if it's like rights for some cable company or some radio station, then it's worth something. Ready? Let's move on. But yeah, they have about 560 million of current assets and 400 million of current liabilities. So they do have more current assets than current liabilities, which is a good sign. That doesn't really show anything about bankruptcy, but I feel like that there could be a possibility for Chapter 11 bankruptcy in the future. Let me go over to this next slide talking about the interest rate risk. Or to the next tab. I don't know why I said slide. Like, what am I doing? All right. Well, the interest expense, right? Let's just look at it for a minute. Obviously, you can see here went from 15 million to 60 million, about a 285% increase from 2022 to 2023. 2024, so in 3 years, it went up 285%. Now, you might say, why the hell did that happen? And the first thing is we go over here. This is from the 10K. Obviously, guys, you need to read the 10K or the 10Q, whatever, and you will find everything about the company will be in there. This is how you do your research. But they have $128 million, which is a variable interest rate. So anytime interest rates move, the Fed funds rate or whatever moves, this thing is going to be directly affected because, on that day. So whenever interest rates are moving, this thing is freaking going to be affected. Now, this would have been great back in the day, but now when interest rates are 5-6%, this is not good for business. So we could see here 8.43% they're paying on their debt right now, which is normal in the economy we're in right now. Another thing is they sold 32 million in convertible notes, and it's at 10%. So I don't know, man. It's not looking good. They're obviously borrowing money at these high rates. Hopefully they could. Obviously they can't, because you can see here they're operating. This is basically their income before taxes and everything. But we can see here that literally this whole interest expense has lost some money. And let's get into these accounts receivables. I didn't really understand this discount program. But it sounds like to me that they're basically like, let's just read it, guys, and you can make your own opinion. We use accounts receivable discount program offered by certain customers and their respective banks. Under these programs, we have options to sell those customers' receivables to those banks at a discount to be agreed upon at the time the receivables are sold. These accounts receivables discount program allows us to accelerate receipts of payments on customary receivables. So it sounds like they give it to a bank, receivables at a discount, they take that money right away, and then they could use that cash to obviously grow faster. And this discount program has been really, I mean, let's just be real, really fucking stupid, because it might sound grand on paper, but with interest rates going up, and we can see here, right? Interest expense resulting from these accounts receivables discount program would increase if interest rates rise. If utilization of these accounts receivables discount program will expand. If the customer extends their payment to us. So interest rates rising. Okay, that's the first thing, right? We can see this rate went from 5.3% to 6.8% in 1 year. And that went their interest rate expense from 26 million to 39 million. And then on top of that, they're getting more of these. I don't understand why they're getting more of them. It's kind of stupid. Um, and we can see here, this should say every 1%. I forgot to cover this part. Every 1% the interest rate go up, their accounts receivable discount program would increase the interest expense by $6.18 million. Like, how insane is this? Um, so, my advice, if you're in this company, is that if interest rates keep rising, this thing will break, and I think there will be a point where management will say, okay, Chapter 11 makes sense. Because why keep waiting around and not try to force Chapter 11 bankruptcy? And I could totally see that happening, because I think this is just kind of stupid with these rates. And I think now, if you truly think interest rates are going to go down, let's just go back. Let's just close out the video. Let's just talk about the analysis. Let's talk about what the upside is, right? So if you truly think interest rates are going to go down, then this stock, you're probably going to triple your money when that happens. It'll probably go back to $20 a share, because that program will make sense, a whole lot of sense, when interest rates are about 2 to 3%. If we'll ever go back to that interest rate environment. But you'll probably end up, the day they announce they're going to lower interest rates, it will probably go up to about $12. In the months following that. Now, if interest rates stay the same for 2 3 years, then this thing will probably file bankruptcy. I would say probably, if it stays the same for a year, that this thing will probably end up filing Chapter 11 bankruptcy with these account receivables, discount program, and the other interest expense. So huge interest expense, we can see that rising. And there's a huge risk with the stock. If you're invested in this, you should look out for that. Alrighty, guys. That will end the video. If you watch to the end, like and subscribe, guys. Of course, I'm starting to get some traction now. I really appreciate you guys who are subscribing and stuff like that. But of course, guys, if you have any other information on this stock, post it in the comments, guys. We want to make the right analysis, get the right info. Yeah, and I hope you enjoyed the video.